This episode of Market Talk is brought to you by Growmark FS. Keeping up on the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic grain and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. And joining us now to talk about the market trade here today, plenty to discuss, including the latest Fed interest rate hike, the soy complex on fire again, and we saw a little bit of weakness in corn and wheat, and we saw some good strength in hogs too. We have plenty to look at. Let's say good afternoon, welcome into Mike Zuzolo, Global Commodity Analytics, joining us here today. Mike, always great to catch up, and as we were chatting a little bit before we went on air, it has been a pretty busy day, just a lot of moving parts in this market trade once again, highlighted by the anticipated Fed news. Just a lot going on today, Mike.
Yeah, I'm hoping over the next 30 or 45 days, Jesse, we can walk away a little bit from the macro side and the interest rate policy and the currency side here, because the Federal Reserve won't report in August. And so we actually get 2 months now before we hear from them again officially. There are some meetings around that they could do some forward guidance commentary, and we'll be on the lookout for that. But I really was hoping that other than the natural gas and the Ukrainian-Russian situation, we could maybe start to limit our focus on the macro fundamentals and do a little bit more catching up on the supply-demand fundamentals. And I think that's what you're seeing between last week's trade and kind of a transition in this week's trade as far as who's leading and who's following in the grain complex. But right now, the Federal Reserve Chairman is speaking. That's as important, if not more important, than the actual policy. But his policy, the Fed's unanimous policy, was to go another 0.75 of a point hike. So we're at 1.5 percentage points now in the last 2 months. They did note that we have softening in some economic data. They also noted Ukraine is creating an inflationary environment. And what I'm assuming is they're talking about the natural gas situation in Europe. And now we have Gazprom, Russia's natural gas agency, cutting European flows to only 20% of normal now instead of this winter. So between the tea leaves that I've seen so far, I'm hopeful that the dollar breaks lower. The dollar bulls decide to jump out because the interest rate bulls decide to jump out as well, because maybe through the commentary, the Federal Reserve is ready to hit the pause button and see how we look going into the end of the year.
Well, on our video feed today on our YouTube channel, pulling up the U.S. dollar chart for the week and kind of just continuing here, that rate hike, that's 2 straight months now, 75 basis points. I believe that represents the most sizable increase since 1980. I might be wrong on that figure, but either way, we look at that. We look at the impact on the dollar. Walk us through this chart and what you're seeing with the dollar right now, Mike.
Well, the thing about the dollar that has to be said when you look at a dollar chart like this is that we trade about $6.5 to $7 trillion a day in a 24-hour time period in the dollar. It is extremely efficient in terms of factoring in almost everything all the time because it has that kind of liquidity to it. I mean, so by far the most liquid financial instrument derivative that you can think of if you're in my line of work. And so the technicals in the dollar mean a lot more to me than, say, the wheat technicals or the corn technicals. I'm not saying they don't mean anything in wheat and corn. I'm just saying the technicals mean more, in my opinion, in the dollar than anything else at this stage of the game. And so what you see is two purple lines that form a triangle, or what I would call a wedge. That's kind of a coil. That's where the market is going from a very wide range from low to high to a very tight range. And it's like a spring, it's like a coil. It's waiting for more energy, for more information, for fresh fundamentals. And I think that's where the dollar chart's very useful in this context. So the purple coil, wedge, pennant, whatever you want to call it, it showed a real tightness about right around the end of May, early June time period. We broke higher once, and then we broke higher again, obviously because of fundamental factors that were supporting the dollar going higher. Many different fundamental factors, but Jesse, now we're under a new pennant wedge coil that is based upon the white dotted lines, and it really matches up well with a coil or a pennant or a wedge in the wheat market right now. And what I'm looking at this point with the Federal Reserve policy and some of their comments out, and the fact that the Federal Reserve Bank of Atlanta keeps a GDP number all the time. Each week it updates a GDP number, and it's been between -1% and -2% ever since June. If we end up having a recession here in the United States, then it makes a lot less sense to go after the dollar, because part of the reason why we're going after the dollar right now in the financial markets is because of the weak Chinese economy and the weak European economy. And so it starts to become less and less fruitful, I think, to be long the dollar without some really good reason to be that way. So if this wedge breaks lower, I will take it at face value unless I see something just starkly fundamentally that I don't think makes sense. But as I said, it's a $6.6 trillion a day market. It's very efficient, and it factors in a lot of fundamentals very quickly.
Mike, I'm going to segue. You mentioned wheat in there, but we're going to circle back to the wheat markets here today. I want to focus on the soy complex. I'm going to pull up the soy crush margin chart you sent me on our video feed, but man, bean meal's been on fire the last couple of days, and bean oil catching on with it today as well. And then soybeans themselves been on fire, especially front month August, maybe some end users trying to pry some beans out of farmers' hands right now. But I just want your thoughts on the soy complex, because it really feels like it's been the driver of the grains here to start the week, and not to mention, of course, maybe some weather premium coming back in here for this soy complex, Mike.
Yeah, all excellent points, Jesse. And I think this is one of those things that, as I said, you're looking at last week. You had the wheat as the leader to the upside, and then late in the week, because of the Ukrainian shipping deal, the leader to the downside. Now you've got the row crops coming on very hard and leading this complex. Wheat more of a follower. Obviously, the wheat and the dollar relationships, why? But the soybeans have really taken the lead to the upside, and there are several reasons for that. Not the littlest reason is the currencies. Again, the Brazilian currency is making an almost new 3-week high right now against the US dollar. That's bringing in funds. You saw the managed money positions in the soybeans, the soybean oil, and the soy meal last week. They have liquidated a lot of positions. You've got Southeast Asian vegetable oil markets starting to come on. And I think most importantly, you've got both products helping this soybean market along with the weather. And it's oftentimes you don't get all three of those things to come together. But the meal in particular is seeing here domestically a crush margin of $1.60 to $1.70 a bushel. That's the best level since May of last year. And I think this is where it goes back to, you have really good reasons to take the beans higher, especially if we stay dry. This chart you're looking at is a soy crush margin in Dalian, China, one of the key areas that they bring imported beans in to crush for their livestock industry. It's at least a 12-year low. I go back to 2010 on this chart. I can't go back any further than that, but we've never been this low in terms of a negative number on soybean crush. It could be an all-time low for the state of that area of Dalian, China. So my point being is, you've got the weather on your side as a tailwind. You've got the currencies on your side as a tailwind, but you are starting to find some headwinds out there. And the number one headwind is going to continue to be China and their buying and their demand side, especially if prices are going higher. So be ready to get back into the hedge mindset and sell the new crop beans, and especially keep an eye on those 23 beans, which crossed through $13 again.
Well, I'll be maybe play a little devil's advocate here with some of those headwinds from China. If we have an extremely hot and dry situation set up for longer than just a week, and we really start to see an impacted soybeans, would that outweigh some of that headwind from China here with the U.S. crop, Mike?
It would for a while, I think, Jesse. I think it's a really valid point, but keep in mind that we do have that 126, 127 million metric ton bean crop in Brazil, and they're shooting towards 150 million metric tons this next year because of the corn and the soybean profitability and the input costs for corn. I think the big thing with China came out from the International Monetary Fund and their update for the world economy. It really spooked me. And you and I've talked a lot about this year. They came in with a GDP number of 3.3%. That's almost half of what it was last year. And that is mass unemployment issues that they're going to have to contend with. And they can only print so much money and drive it into the economy to try and offset it. They've got a real serious problem. And so now between Russia and their gas problem with Europe and their gas problem with Russia, they're probably in a severe recession now heading into the end of the year. China's probably heading into a severe recession heading into the end of the year. And then that leaves the United States. So I think that's the bright light of maybe why the Fed won't go crazy on raising rates at the rest of this year. And maybe that gives the commodity bull a reason to step back in without worrying the Fed will chop his head off if he buys into the grains especially. But we got to keep China first and foremost on our minds about their demand side, especially if our head of our House of Representatives goes to China against the Department of Defense mindset, and China does something with Taiwan. You could see almost within a month, I think, another Russia-U.S. scenario in terms of how badly our relationship could become as in a quick amount of time. So China equals beans to me and equals pork to me, and I just want to keep that in the forefront of our minds.
Mike, let's segue over and let's talk about corn and wheat. Wednesday's action there. I think we can maybe combine corn and wheat a little bit at least. Wheat market finding some pressure, better than average spring wheat yields on the spring wheat tour this week. I think that might be a bit of a weight on top of some of the things you mentioned already with the dollar, et cetera. And then corn just felt like it's caught in the middle here today as we work through the trade. Would that be your kind of assessment of corn and wheat here a little bit today?
Yeah, I mean, if you're talking hot August weather for the soybeans, you've got to talk about it for the corn because our silking percentage was only, I think, 62% this week. That's 14 points behind last year, Jesse, and we're already 3 points below last year in good to excellent corn conditions. I found it real interesting that the Bunge CEO came out today and said that he feels like we're backing off of a trend line yield in corn. I couldn't agree more. I think that 175 to 178 number is quickly being lost. We're quickly slipping out of our hands if this weather pattern is what ends up being on the models is actually what happens, because the ridge has broken down, but there's now a trough that's too far down south. It will help some of the droughty areas of Kansas and Oklahoma and Texas, but it's too far south for the plains and the western corn belt. Iowa and Minnesota have to do a lot of making up for a lot of bad states at this point, and it doesn't look good with a very short behind crop at this point. So corn followed wheat today, in my opinion. I'd expect that to divorce themselves from that, but I'd love it if the wheat would join up with the corn and beans because we've got a dollar that's breaking lower.
Now, Mike, with the corn crop as well, you alluded to Iowa, Minnesota. I'll throw Illinois in there too. It's, a lot of pressure on those states to try and make up for what we've lost in some of those outlier states, we'll call them. Kansas, I've seen Kentucky, Tennessee, a lot of these states with real bad pictures of crops there. But also, I feel like there's some skepticism in the trade. Some folks who maybe don't quite understand, or whatever the case may be, that the corn crop's made because we're moving to August. But this corn crop's not completely made by any stretch of the imagination. It could be in some areas, but it's not completely, Mike. And I think that perception's maybe being thrown around in this corn market a little bit.
I think you're 100% right. I think the other thing traders are relying very heavily upon is the idea that last year at this time, Minnesota was only 38% good to excellent, and it's almost double that this year. And Iowa's really doing well compared to last year at 80% versus 65% last year at this time. And I'll re-stress it, from what I can tell, and the price actions validated this, I really think the traders are honing in on those two states and their crop conditions and vegetative indexes specifically, and that's going to drive a lot of buy-sell signals, if you ask me.
Mike, let's talk energies. You sent me an unleaded chart here for this week, and I want to go through this on the video side. You can see it, and then also talking just in general about energies. I'm hearing more and more whispers that some energy folks are calling for farmers to try and lock in some needs ahead of fall. But I'm just curious your thoughts on where we stand with gas prices, diesel, the oil market, and just energies in general.
Yeah, we took a dive in the supplies this week for both unleaded and diesel, more than I think the trade was expecting net, Jesse. Between that and the Federal Reserve and the dollar and the fact that the crude oil and the dollar tend to work very much in opposite directions with one another, especially the West Texas intermediate, which is priced in dollars. That's what this chart's kind of about. Is we've seen the West Texas Intermediate price get led down by the electronic unleaded futures. So unleaded has been the dog, the crude oil has been the tail. Now we're starting to see the dollar come into play, and we've seen that the unleaded price has dropped substantially in the futures market, almost 50% pullback from its blasting off earlier this year at the first of this year. Whereas the retail unleaded gas price, it's fallen, but not nearly as much. So because of the Federal Reserve meeting and because of some of the data that I'm looking at, I too am really watching closely what's going to happen here on the charts and with some of the supply demand fundamentals that we get at the end of the month. But I probably will be recommending fall needs to get booked on the energies, especially for diesel and maybe for even unleaded, because as we talked about last week, maybe we don't go up and make new highs, but with what's happening with Ukraine and Russia and Europe, we may be able to go back up to the old highs. And I just don't want to get stuck there and locking in fall needs and being wrong by locking in fall needs. At least we can go ahead and lock in cheaper needs down the road.
Well, Mike, let's transition out of energies. I want to give us time to talk livestock. I've used this phrase a few times here this week and last week. This hog market's like a freight train, just running forward. I don't want to get in the way of it. Another strong day today, cash supporting. What do you make of this hog market, specifically front month here? Because we're starting to get a pretty wide spread between August and October.
Yeah, we are. And we're starting to see that belly cutout ramp up for another leg higher, and it's helping the whole pork cutout. And as a result of that, the August hog futures, as you say, is trying to keep up with the cash index. So to me, we don't have to overcomplicate this market, Jesse. Once the cutout led by the bellies is done going higher, and seasonally that first week of August, it can be a topping area, especially for the bellies. But once we see that, I think we do want to go ahead and look at getting some hedges in place, possibly for October, maybe for the deferreds, depending on how premium they are. But like you said, there's a big discount in October versus August. It's really about the cash and the nearby. Kind of tells you that the consumer's not backing down at this point, and that the pork chops and the spare ribs are really gaining good market space and advertising space. I saw it again in this week's update. It seems like ground beef, 80%. And then the spare ribs and pork steaks and pork chops are really leading. Even the chickens are kind of falling behind with high-priced chicken meat.
Well, on the beef side, looking at cattle, feeder cattle found a little support today. I was surprised by that, as corn held, we'll call it, relatively firm. But then live cattle just fairly mixed today. Cash trade looking to be $1, $2 lower this week. What are your thoughts on the cattle market, Mike?
It makes sense that with all the uncertainty on the weather and the idea that feedlot country is going to cool off and get 2 to 3 inches of rain by the end of this week, this upcoming weekend, that the Packers would be taking a stand-aside approach to this market right now. Having said that, I still think the live cattle have a lot better price in terms of not as much premium in them as feeders do. We still have that $8 to $9 premium in the feeder futures for August versus the CME cash index. And we've also seen that feeder fat spread get up to a premium, a 3 to 6 month premium at this point. I think it got up to around $41 or $50 here this week. So I think the feeders really need the fats at this point to go higher. And I really do want to watch that corn feeder spread. So if I were a hedger, which I am, I'm getting more eager to get feeder hedgers in place, especially if we can gain another $3 or $5 led by the fat cattle market.
Well, Mike, fantastic stuff as always. Again, today, floor is yours here before we run out of time. Any final thoughts or anything else you want to reiterate for us today?
Just go to globalcomresearch.com and sign up for a trial. Would really appreciate the opportunity to work with you. It's globalcom with 2M's research.com, and just sign up for a trial and shoot me a text on that and under the comment section.
Well, Mike, always a pleasure, sir. Thanks for the insight and analysis, and enjoy the rest of your week. And we'll talk to you next week as we get into the month of August already.
Appreciate you having me, Jesse. Thanks very much.
Mike Zuzolo, Global Commodity Analytics, our guest today here on Market Talk. That's going to do it for today's program. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.